Tom Lee, above 4,300. What would it mean, do you think, to the validity of this move if we were able to close above 4,300, Tom, on the S&P for the first time since last August?
Scott, round numbers matter for a lot of folks, especially just sort of thinking of psychology. So 4,300 is a big deal. And probably more important is 43.25, because that was the August highs. And I think from a sort of those who are skeptical of this move, I mean, one thing for them to keep in mind is that, next week, given the short positioning, we know that in both the futures, the sell side strategist target prices, and retail sentiment, if the Fed does sort of acknowledge a pause is justified, I just think that you're going to see a lot more position squaring. So that 4,300 then would serve as support, and we could make a move substantially higher. So it's a big deal, Scott.
It's tricky, though, Tom, with a Fed meeting looming, a CPI report coming next week as well. If this is, in fact, the beginning of a new bull market, it could prove to be perhaps the shortest-lived one we've seen in some time if those are disappointing events as the market would take them.
Scott, I think you're kind of right on. I'm not sure if someone has been investing since October or steadily throughout the year, they're sitting on some nice gains, especially on FANG. If someone's trying to decide if they want to be buying stocks today on Friday ahead of the Fed meeting, you're absolutely right. I mean, it might be prudent to wait till after June 14th. That being said, I don't think the symmetry of this risk is actually that we re-enter a bear market. I think if the Fed does say they want to be hawkish and they're talking about 2 more hikes, is that going to justify the S&P going back down to 3,500? I mean, I might just say no one's going to really want to sell the FANG, and the PMIs globally are bottoming, so you still want to stay cyclical. And again, as I point out, like anyone who's been overweight cyclicals, which is a bull market trade, has done really well this year. So I think it is a timing question, but I don't think it means that we could be slipping back into a bear.
Let's expand the conversation, Tom. Bring in Kevin Gordon of Charles Schwab and Victoria Fernandez of Crossmark Global Investments. Kevin, begin with you. You're sitting here right next to me. What do you make of what Tom Lee says? It's the bull market for sure in his mind, and it began a while ago.
Well, I think you still have a long laundry list of things that just have to be checked off. And much like you were covering and you've all been covering all week, which is, lack of participation from small caps, the average stocks, cyclicals, Dow transports, the advanced decline line. I mean, the list goes on. So I think from that perspective, objectively, you're not really in a territory that would be consistent with what we've seen from prior bull markets. So in that aspect, you're kind of making history either way. It's either the longest bear market rally we've seen, or it's the weakest start by far to a bull market that we've seen. And I think just at this point, 8 months off the low, the fact that the banks are still down, small caps have barely moved. You're even giving back some of the move today in the Russell 2000. And the fact that, new highs relative to new lows on a 52-week basis haven't yet gotten in that consistent double-digit territory for the broader market. So I would just base it off of that. I don't think it's any precursor, at least the the mega cap sort of narrowness in the leadership in the rally. I don't think that is necessarily the precursor for weakness. I think it's the lack of any movement for the rest of the market. If you start to see what we saw last Friday and in the middle of this week, where you get much more participation, that to us would be much more favorable. You can get much more constructive, but it's just not happening yet for the broader market.
So in light of that, Tom, let's do it point counterpoint. What's your counterpoint to what Kevin just said?
Well, I mean, foremost, I think at the at the core, a bull market isn't defined by an advanced decline line or small caps. It's historically whether or not the index is advancing. And as you know, in 2009, after the March 09 lows, there were many people. I mean, the vast majority of people argued against a new bull market starting because they said the banks were lagging, and they pointed to the internet bubble, so they didn't think tech could be the leadership, and they pointed to what they saw was very poor prospects for investment spending and a hostile government. I just think people build a case against a rising trend. I think that's probably the most important thing I would point out. The second is a lot of these things that I think are fair, like the lack of participation, can really change if the Fed signals they're comfortable with where stock prices are. So I think next week's a big moment. I mean, I can't say I know what the Fed's going to say. And, if the Fed says inflation's still a problem, I think it's going to create the bifurcation still that, we have the FANGs and we have the tech and things that solve inflation and everything else. And it might feel like a two-stage market. So I think Kevin's bringing up fair points, but those historically aren't good arguments against a bull market.
Okay, Victoria, how do you see it here?
Yeah, so I lean a little bit more towards the bearish side on this, because I think when I'm sitting down in front of my clients, I can say, yes, we've seen some positive things in the market. Now, just over the last week is when we see the breadth really come back from around 30% of the Russell 3000 above their 20-day moving average up to around 47%. That's great. We like that. But you look at the factors that are still doing well in the market, risk on and momentum factors are still lagging the quality factors, which tells me that we're still a little uncertain as to what's going on. And you have to look at leading economic indicators down 13 months in a row. And Scott, the level of change that we have seen in the LEIs, we've never had that level of change without going into a recession. We're just now hitting the time period after the first rate hike that you typically go into a recession. And there's a lot of these under the element kind of pieces that we're missing. We had the bank crisis earlier. We talked about commercial real estate. What about private lending? We've seen private lending increase significantly over the last month. Is that an area where we have to be concerned? Rising debt cost, the illiquidity that's coming, and the sectors that usually do well during those time periods are the things we're talking about that are lagging right now. Healthcare, staples, value names. So I think you can't have a confirmation bias as to whether you're a bull or a bear. You have to take it all in. But saying that doesn't mean if you're bearish, you're out of the market. We've never been out of the market, even though we've had a bearish view. It just depends on where you are within the market, and I think that's key.
Kevin, the issue is there's a lot of uncertainty, obviously, and there's going to be. The market's already up 20% off the low. By the time there is this alleged certainty, whatever bell rings that suggests it's here, the market may be even further down the tracks.
Bell meaning the recession itself, or bell
no, that there's no more uncertainty, that we're certain we're actually in better times, that we may not have a recession, that this, in fact, is the beginning of a new bull market.
Yeah, and in some ways, I think that extends kind of the timeline that you can be constructive. If you push back the recession, the only, I think, negative down the road for the market is if you push back the start of the recession, typically you see markets dive when recessions start. And I think, as it pertains to the Fed and monetary policy and the clarity around that, yeah, that'd be a welcome sign if you get any indication from Powell and from other members, whether it's next week or following that there is more clarity. I think that'd be welcome. At the same time that you do have more of a catch-up from everything that's gotten beaten down. So again, to the point of it's not necessarily just concentrated leadership that's going to get you, the reason to move lower. The best case scenario, the most benign, is just kind of maybe muddle through at the top end and then giving the rest of the market a chance to kind of catch up a little bit.
Victoria, you heard Tom still favor FANG, which has led the way, and I guess for obvious reasons. How do you feel about that space here? Is it time to take some gains, or just continue to go with these stocks because you believe that fundamentally in what is a fairly uncertain world, you get at least a degree of certainty, better balance sheets, better growth. They're in the right, where the action is, so to speak.
Yeah, I think you need exposure to these names, right? We're underweight those names, but we still have exposure to them. You don't want to be completely out of these names because of the momentum that they've had. Now,
I understand. I know. I'm sorry to cut you off, but if you're underweight those names, you're underperforming the market. I think that's my point.
Yep.
At what point do you say, you know what? This is where the action is going to be. So where I was underweight, I'm going to go overweight, or this thing is going to get a little bit further away from me while I'm still thinking that the more cyclical or value part of my portfolio isn't going to come around like I thought it might.
Well, and I think that's why, at least in our portfolios, you have risk parameters around how far you want to make that bet in these names. So we've actually added a little bit in some of these tech names because we don't want to be too far underweight, but we're not sure we want to be exactly market neutral or even overweight, because we do feel like there's going to be this rotation and some of those high flyers are going to pull back a little bit. But where we've added and where we're not necessarily underweight in tech, look at names like Salesforce. We've actually added to Salesforce this past week. That's a much more reasonable valuation than some of the other names in the space. So I think you can still add to tech. You can still have the exposure to those big names, but find some other elements, some better valuation names that you can build that sector and have some exposure that I think will start to catch up a little bit with some of those names that have already made that big move.
You've been negative, Kevin, for a while on the market. You've been cautious for certain most times that you've been here. Whether last week was the start of the broadening out or not, it certainly got a little more broad than it had been. You saw what small caps, for example, have done. At what point do you just say, you know what, it's time to be more positive?
Well, I mean, constructive, we got a little bit more constructive at the October low when you did start to see kind of the conditions you would want to see at the beginning of a new bull market. The problem is that just didn't sustain itself. So now us being 8 months off of the low, not seeing, any conditions that you would want to see from a breadth perspective when you get to this point. So we'd get more constructive if that was the case.
But I mean, there are other areas of the market that have started to pick up, which would suggest that what was a very top-heavy market isn't such.
Yeah, absolutely.
Anymore.
No,
and that would lead
100%.
people to be more bullish than they've been.
Yeah, and I think that's what you want to see. So like we were saying over the past week, you want to see those kinds of moves, but they have to be sustained and carried forward. So on a day like today, I mean, one day doesn't change everything. But if you kind of see these reversals and you kind of have everything going back into just those handful of names, I think that presents a little bit of a problem. But to the point around anybody who is bullish, start to look for some of the signs at the sector level, even that participation is broadening out, because even in industrials, for example, equal weight industrials relative to cap weight is doing really well. It's the same thing in utilities. Two different plays from a cyclical versus a defensive perspective, but it's starting to show up in different parts of the market. So I would be, wary of, or at least alert of that and aware of that, and take hold of it.
All right, Kevin, thank you.
Thanks,
Victoria,
Bob.
thanks as well. Tom Lee, we'll talk to you again soon. Appreciate you joining us. Don't miss, by the way, when Tom joins our CNBC Financial Advisors Summit next week. That's June 15th. And you can scan the QR code on your screen to register or visit cnbcevents.com/financial advisor. Let's get to our Twitter question.